Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as on StockCharts.com. So, working through the markets here, we've obviously got ourselves in a bit of a pickle. We have more than enough pressure going around to the downsides. We're down on the Nasdaq almost 10% in the 3 days here. So it's been a rough one. On here, I want to talk a little bit about just how we lost 3 months gone and thud 3 months gone in 3 days, and the real issue going through the markets here. Part of it was coronavirus, but part of it was on the back of a very euphoric setup. And so what happens is that euphoria ends quickly, and the catalyst or the match that might light the haystack on fire was probably the coronavirus. But we were also setting up with a whole bunch of different things. We're going to try and talk through some of that just as a little bit of a historical. So this isn't I should have told you so. It's more like, how do we recognize this stuff in advance, and how do we deal with it so that we're ready the next time that the market decides to vent on us? So options expiration day was a smackdown, and I want to review that for a few minutes. Just spend some time looking at how some of the option expiration days have been in history. And it doesn't mean the market will collapse on an option expiration day. It can break down or up anytime it wants. But there's also a lot of transition that happens around that day. So I want to emphasize that in the charts once again. So breadth charts to help find lows. We're going to look through those. And on that, it also can help us look where support might be. Now, we have a couple of different things we can use there. We could either use the breadth charts for support, or we could use the actual index levels for support. We can see past examples. So there's some really good clues, especially when we have sudden moves down, when we kind of have a drip down. Maybe the breadth charts won't tell us that much. But when we have these sudden moves, we can use those a little bit differently. And lastly, I'd like to talk about how bond yields have blown through support. The 30-year and the 10-year making new lows. That's a big deal. Now, we don't have new lows on the 5-year. So it's kind of those two. And then if we get time to get all the way through the bonds, we'll continue that discussion on Friday, if not. But I want to specifically go into some of those areas. So let's jump over into the charts. So first of all, this is options expiration, and this is looking back at October 2018, and I think we all remember that as being a very painful experience. But what we saw was a big uptrend in price, and here was the options expiration, and so that actually made our high, and then we retested the high, and then we fell away. And on the next options expiration, we kind of got to it, and then we fell away. And the next options expiration, we kind of got to it, and we fell away just for a few days, had a big rally, and then pulled back. Now, the one thing I want to point out here is when you look at the first fall, the rally is only a few days. The second fall, the rally's 4 days or 5 days. The next fall, the rally's 7 or 8 days, and the next fall, the rally's bigger. So one of the things that we see is the move down and the move up are equally difficult, and the deeper the market corrects, the more difficult it is to trade well through that period. And the other thing to keep in mind is when you have high volatility both ways, it's hard to make money both ways unless you're really an intricate day trader. And congrats to those people who have the courage and the conviction to trade through it. I'm one of those people who like to just kind of back out of the market when I get the clues, and then go back in when I feel like the market is setting me up for a bounce. So even if we got a bounce this week, I'm still not expecting a big market rally out of the hole here. It might go halfway back up, might bounce 5%, but I still think we've damaged the underlying of the market. And not only do we have the coronavirus, we still have the economic slowdown impacts. Now, the market's going to price that in advance, and maybe that's what this 10% is already about. But we were very stretched to begin with. Again, we had lots of stocks making parabolic moves. We had the whole market rushing into the top 10 tech stocks, and they were all going ballistic. And then we have oil and all of the industrial metals and stuff all breaking to the downside. So those areas were completely bombed out. And then if we're going to start improving, because remember the whole thing was backed up with the idea that we were going to start getting global growth again now that the trade deal was done, or phase one of the trade deal was done. And if we could get global growth reignited, then that would give us the fuel for the whole market to kind of lift back up as everybody goes. So we haven't had that lift back up, and now we still have this problem where all of a sudden now we've got something that's actually dragging down the first quarter. So we are halfway through the first quarter, and so I think it's important to just keep that in mind, that the recovery might not be as quick as everybody thinks. I'm only going to say this once because I don't want to scare anybody. I want to say it just from a matter of now that we're going to go look at this breadth. This breadth data gives you some idea of history. But if we go back and look into 1987 as an example, the market had fallen for 6 days in a row and then fell 25%. So you get these huge moves that could happen. And so somebody said, well, we're down for 2 days, so we should start rallying now. I would agree. A lot of the breadth measurements are on extreme levels, and they're a good place for us to start to look. But just because it kind of looks that way doesn't give us any real reason to use this as an absolute. So you still need to, if you were going to try and trade off it, this is how you would trade off it. So here we are down here, and we have a breadth level of minus 700. Well, if we look across this chart, we'll see in August we got down here, and what you see is we fell quickly, and then we had a bounce, and it was roughly a third or something, and we spent a month going sideways with no real push up from that level. And then we can, say the same thing happened in October, and obviously we got a much better bounce. In October, we bounced and we kept going, so that one was more promising. And we actually had a retest of the low, and then we had a higher breadth reading on the second test, and that was probably a better clue. Looking back in October of 2018, where the big pullback that's shown here on both the breadth data and on the index, we see this sliding down. So this is the 11-period moving average, or a 2-week rolling average. And what we see here is coming out of September, we actually marked the highs pretty much around the options expiration day, and then we started to fall away. We got all the way down near this minus 1,000 level reading, and then we rallied up and pulled right back down, and we didn't get anywhere near a 5% rally, maybe a 3% rally or something to get us going. So I just want to caution, when we're down here, we're at extreme levels, but just because we're at extreme levels, there's many times where this knife fight turns into a gunfight and it gets worse. So just keep your wits about you. We might bounce here, and if you were short covering, I fully get that. That's usually what causes the first few percent of the rally. But the main thing to keep in mind at this point is we still do have some economic damage going on here. It's not just fear. There's real actual companies reporting problems with getting product, and the Port of Los Angeles is down 25% as an example. Paris's tourism is down 40%, and we're just starting to get things in Milan. So if that was happening already, what's going to happen now? So try and keep those things in the backdrop, just if you were thinking of being a very aggressive trader on the back of extremely, extremely bullish sentiment. Okay, so here we have the uptrend from October, and we've wiped out, we're back to kind of, on the Nasdaq, not too bad. We're only back to the beginning of the year, but on some of the other charts, we're back into the late November, early December timeframe. But one of the things we can see here is we have an uptrend in the advanced decline line, and I have this other trend line drawn in here, and I didn't know if we were going to break through it or not. But at this point, we had lower breadth and we had higher highs, so we had a divergence. And here you can see that we rallied up, and then we had the spike high, and then we pulled down. And then on this rally, look at how little accumulation there was of the number of companies participating. And all of a sudden we rolled down. So there were some clues there for us. And down here at the bottom, these are spikes. I have trouble using those to any real advantage. You can go and compare them, but these spikes can come right after the highs, or they can come on the lows. So I don't find that as helpful, but I do find when we break these big, long, cumulative trend lines, so we add together the gains from one day to the previous day and keep that running tab going forward. And then in this particular case, we do have an uptrend where the October dip briefly broke below it. But I would say that we've got, 1, 2, 3, 4, 5, 6 touches here. So this is a pretty reasonable line, whereas this one only has 2. Anyway, we broke through that 6-touch line, and now we're coming down here. That might be a place that we could bounce, right? Just literally, how far down do we get here? And I'll show you a reason to kind of think about that. But the other thing to look at is look what would happen up here. We would come right down to the trend line where price meets the 2019 trend line, going all the way back to the December 18 lows. That would also be a place to expect it. So we're at 89.65. This line looks like it's at 87.50. If we had still more selling to do, that might be a place to look at it. So let's just call it 8,800, somewhere down in that range, another 100 points. And then perhaps we could get a lift out of there. So here's the high-low, and the way I like to use this high-low, look down here and see the data, and as we look across, typically this is kind of the level of the normal bounces. You get down to this kind of difference, and all of a sudden the market will react to that and give you a bounce. Now, sometimes the bounce might not be much, again, but we're not in one of those big dips here so far. I actually think the market was set up for the October to December 2018 timeframe based on my other breadth work and how euphoric the rally was. But we are at a place where typically the market has bounced. So very few times does it get much more oversold than before the bounce. Now, again, keep in mind that just because that's where it's bounced before, we have lots of examples of where it gets worse than that. So if, as an example, let's just say it pulled down, it rallied for a day or two and then pulled back down into early next week or whatever, this would still be normal, and we've seen it in recent history. So these are some of the places to expect potential bounces. I wouldn't dismiss if we didn't bounce out of here and we made a deeper low, but I would just say that we are getting to a very extreme oversold level that normally is enough to send the market bouncing back up. So on the Nasdaq composite, we had not reached the 2019 trend line, but on the New York composite, we have. Now the opposite is going on here, where the price has, or the advanced decline line has also reached this long trend line, and it's not off the lows. There's another trend line that's been forming in here, and one of the things that's interesting is the October bounce was right on that trend line, the December bounce was right on that trend line, and the January one didn't even pull back to there. But once again, this didn't really try to keep making higher highs here, and you can see price started to fall away, and on the New York composite we made a lower high, and we also made a lot lower. This last rally had a lot less stocks participating, so this was smaller in height and shorter in width, and so the rally didn't last long. But we've clearly pulled down here. If we were going to bounce off this advanced decline line like we have before, that would be fine. But again, we're getting to an interesting place on the chart where this is at least a potential place for a bounce to say, let's use it like that. And then the other thing, obviously, if we were just to use price itself, we would go back here and say, okay, well, at 13,000, that was pretty close to the high here. That was support for this high. That was resistance here, going all the way back a year and a half ago. On the October high, we were right around this 13,000. So we've kind of got a place to look for a long-term support and resistance level. Okay, so again, these two spears down here, these are the lowest on the chart. So obviously there have been pretty major selling. The only thing I want to just keep refreshing is, if we got, 10 cases of this in New York and 10 cases of this in Houston and 10 cases in Seattle and 10 cases in LA, the market is probably going to be a lot more worried than it is so far. So not predicting that we get some, just suggesting that, any sort of news panic could hit and we could still find ourselves that these lows don't hold. So looking at the the Dow or the New York high low. Again, we're down here at a level where commonly we bounce from, and you can see almost every year we go lower than this level on a bounce. It's early in the year, so let's not frame that too tightly. But here we are in January of 2018, and from the same sort of levels at the top, we immediately jerked down and we got slightly lower than this and then bounced back up. So we're definitely in a situation where we're getting close to a low. And again, it could only be a couple of days. It could be the low. We don't know that. All we know is that we're getting into a very oversold situation. Okay, so the next three charts are the different types of groupings in the stock market. And so I want to talk about the S&P 1500. And again, this uptrend is off the 2018 low. And I didn't pick this exact low here. I picked these because then we have more support points or more touch points. Anyway, we broke through that line yesterday, and today we continued down. So the uptrend in price off the 2019 low for 1,500 stocks, the top 1,500 stocks, is broken. When we look at the advanced decline line for that same basket of companies, it's also broken. Now, we haven't broken support from I'll call it the January low even. So some people would be very optimistic and say that's no big deal. What I would say is back here in 2018, when the big uptrends break, that's a pretty good place to start to be cautious without question. And the other thing that I would add is there's not too often that the stock market drops 1,000 points 2 days in a row and doesn't have something bigger to worry about that's going to last more than tomorrow morning. So all of these charts are suggesting a major breakdown is underway. I would suggest a couple of day rally is coming, but like I pointed out before, the first few rallies are only a few days. And then as you get deeper into the correction, the rallies are, when they roll over, they fall even harder, and the rallies are even longer, and then they fall even harder, and the rallies are even longer. Doesn't have to work out that way, but a lot of times you kind of see that rhythm in the charts. So here we are with the mid cap, and we see this big uptrend, and we've clearly broken the line on the mid caps, and we've also broken the January low. So to me, this chart is broken and damaged, and we're below a lot of the support that we might have thought from May, August, September. And here again, we see a downtrend in momentum. We saw that the width of this is pretty wide and pretty high, and then this one is a little shorter in width and a little shorter in height. This one is shorter in width. This one is shorter in width and height. And so all of a sudden you can just see that we're losing steam as we get here and we start to break down through. The uptrend line for the advanced decline for this mid-cap group has also been broken, and we haven't quite got through the advanced decline lows of late January, but I think it would be wrong to assume that this big uptrend on all of these don't matter. So on the 1,500, the 600, and the 400. So here's the small cap, and on the small cap we broke through this as well. We had the same sort of thing where we had a lot of stocks participating very high and for over a month, and then here it was almost as high for 3 or 4 weeks, and then here it was 1 week, then here was a couple of days, here it was a week, but less stocks participating. So the height is the number of stocks and the width is the length of time they're rallying. And we were sitting down here. So for the subscribers of my newsletter, I was describing that, we've definitely made lower highs in the advanced decline line. We're taking out the lows from January. If we break through here, we're breaking the year-long uptrend. So now we've broken the year-long uptrend on all three of these different variables. We've broken on the Nasdaq a shorter trend line, a 6-month trend line, and on the New York Composite a 1-year trend line. So to me, it looks like it is breaking down. And again, I don't think the market's going to sell off 1,000 points 2 days in a row if it's immediately going to try and believe that everything's better. I think we had another 4 countries that showed up with coronavirus today. So there's still bigger issues out there. I want to briefly cover off the Canadian market with the Canadian subscribers. And what we see here is the Toronto stock market has also broken a very clean uptrend, and it's been testing this uptrend numerous times, but we clearly broke through it. I would say support is down here around 16,750. That would be this horizontal level. And looking at the advanced decline line, it has not been rising as of late. So January was higher than this February bump. And what we see here is, while the US market was continuing straight up like this was really jogging sideways, but it was still able to climb based on the size of the companies doing the heavy lifting. So with that, the Canadian market, I would just say it's broken the 2-month uptrend or the 3-month uptrend. It's still pretty much churning sideways, but without question, the trend line is broke, and there was no real participation on the last rally either. In terms of overall selling level, down here around minus 200 is a typical place for the stock market to bounce. So if it was to bounce, I literally think it would probably force a bit of short covering, and that would be about it. So here's the high-low data, and again, we're down at these levels that, once we kind of get down to the minus 75 level or whatever, that's kind of a good place to start to think about, a big pullback. So we're there. Any sort of a rally, I would just be very careful on trading the rally for a long period of time to the upside. A couple more things to look at here is the McClellan Oscillator. It is rolling over from a very high level. I will point out that as long as this 400 level holds, we're probably more inclined to turn back up and the market will at least jog sideways. What happened in September, October 2018, we were kind of up at these levels. And then when we broke through the 400 level decisively, that's when the kind of rainfall started. So because we had so much euphoria, we were way up high here, but you'll notice on this last bump, it was nowhere near the stock market going to a new high. The New York Composite trying to make a new high. And then what we saw up here was a lot less participation. So we're down at a very extreme low. If we look across this chart, it doesn't get much deeper than this. And so that's a place to at least consider whether or not we can rally out of the hole here. But these red trend lines, a lot of them are down at similar levels to what we're at now. And you can go through and look. It doesn't necessarily mean we're going to bounce here. So anyway, keep that in mind. The summation index is up at the top here, and that's literally making a cumulative total of this McClellan Oscillator from each day. So I also like to plot that same picture that we saw on a weekly chart and then plot it using candlestick charts. And what you see here is just kind of a general trend. And for the last 3 weeks, even though the market rallied higher, this summation index did not. We just kind of hung around here for a while. And now this week, we've clearly fallen out of bed. When we go below 400 on the summation index, that's a place to focus on. Well, probably by the end of the week, we'll end up being somewhere near there. If we want to look at the New York Composite going back to 2009, I would say the trend line is down around, if we got to 12.5, we'd probably think about breaking that big long uptrend. And the 2018 was just outside it. So just below it, and then we rallied out of here. So anyway, we've still got some room to the downside to try and consider. This is the Nasdaq, so same chart but different levels. And for me, once it goes below 0 or minus 200, that's really when things start to correct. Now the Nasdaq was so extreme that here is the uptrend from 2009, and we actually blew out through the top of it briefly here. That's just one of those examples of, this was an aggressive move, let alone having so much momentum. We blew right out the top side, and sometimes you see that as an exhaustion surge that finishes your rally. Okay, I have just a few minutes left here to cover off the bonds. And what I want to show you on this LIBOR chart is look how this has just been plummeting day after day after day, telling us that something's wrong. And again, we were up here at 195. You can see on the chart that we were going down for a long time. But all of a sudden, this thing, after basing in here for the fourth quarter, it literally, starting the beginning of the year, just started to let go. And so as we kept plummeting, I kept going, gee, why is this chart so different from the 3-month? But literally it has been one of the clues that's telling us something's wrong out there, and I mentioned it in my videos. So here's the high yield. We had an uptrend going. That's broken down here. We're below the 10-week and the 40-week moving average. I would say there's horizontal support in here. Now this is the unadjusted, so I've backed out the dividend payment. I want to skip down to look at the 30-year. Well, actually, let's look at the corporate bond. This thing is still screaming higher, and Paul Tudor Jones says this is the next place for trouble to show up. He mentioned it at the end of October 2018, and of course, that's when the market was November 15th. So that's when the market ended up making its lows down there, and we've gone on a screeching run since then. The real question is, will that same information hold up as this comes from a huge overbought area, much like we're seeing in the actual stock market? So for the S&P 500, this big uptrend off the 2009 lows, we've still got a little bit of room below here. But I think if we start to have problems in the bond market, obviously that would add more pressure on equities. So let's go look at the 30-year bond, and I just want to flip to the last 5 years here. And what we see is this chart is clearly breaking below support, and momentum has been going down. This is rolling over below zero. It was one of the clues that told me the bond yields were probably going to just bail here. And they've literally been falling since the beginning of the year, suggesting something bigger is wrong. If we go to the BlackRock Municipal Fund, I like to use this to help me with the 10-year. And this thing continues to push higher, and it has since the beginning of the year, just saying, you know what, the bond yields, people are buying municipal bonds for safety. And so what that says on the 10-year is that bonds are probably going to go the other way. So this week, well today, we made a new low of 1307, so 1.3% on the bond yield. And you can see that's below the previous low that we locked in here on monthly chart. So we're in way oversold territory. If it started to bounce down here, who'd be surprised? Look at the momentum indicator. It is screaming extreme, but that doesn't mean it can't go further. And then if we go look on this, that was a monthly chart. This is the weekly. So in here, we came down in September, and then we started to rally in October, and now we've started to give it all back again, changing right at the end of the year, or the beginning of this year. And you see that this big downtrend in momentum has held and is starting to roll over right at the point where, you know, oh, that's not a great place for us to roll over and lose momentum. So it's one of the big areas that I think we need to stay focused on. What does this bond market try to tell us? And when we go look at the yield curve, it's literally exploding. So when we see the spread here, what's happening is that the 30-year and the 10-year, which is in brown, should hold up a little bit better, and these other ones should start to fall away. And as they start to fall away, that's the sign of the bond market normalizing, but that usually doesn't happen. We still have this breakdown where short-term yields get very short, and the longer ones start to hold up and spread this picture out for a while. So that's one of the setups that I'm looking for and waiting to see. I will show the 5-year here, and what I want to point out on the 5-year is that this is the daily chart. We've clearly broken through support here, but if you go to the weekly chart, we're not below the 2012 and the 2015 lows. So perhaps this level of 0.95 could be an area that we'll find the 5-year bottom on, and perhaps that will give us some place to bounce from. You can clearly see the downtrend in momentum, but if you just looking back in history, we can go a lot further than this, and we can do it repeatedly year after year as we did in those periods there. So thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays and Friday at 10:30 a.m. Eastern. Thanks, everybody. Bye-bye.